Well, hello, and a very, very happy 2026 to everyone listening. I hope you had a fantastic holiday break.
Happy New Year.
We're back and ready to kick things off by diving into one of the most fascinating companies out there, a true anomaly in retail.
We're talking about Costco, ticker called PAT.
That's right. We got a great stack of sources from you all on Costco Wholesale, and it's time to really unpack the business model that seems to have Wall Street, well, pricing it like something it's not.
It's definitely not just another big box store. That's the key.
Yeah.
It's a case study in building a structural advantage.
So what's the mission for today's deep dive? What's the thesis we're testing?
The core idea is simple, really. The market is valuing Costco like a high-end tech company.
A tech company.
Yeah, think of it as this incredibly high-speed logistics operation that just happens to be funded by what is essentially a SaaS-like subscription model.
SaaS, software as a service.
Exactly.
Yeah.
But it's anchored in real, tangible goods. So our job is to figure out if that valuation, those historically high PE multiples we're seeing, are actually justified.
It's the ultimate paradox, isn't it? They sell fewer things, they charge you less for those things, and then they charge you just for the privilege of walking in the door.
Let's lay out the numbers real quick, just to set the stage. We're talking about a global giant. Annual revenue is already north of $254 billion.
And the foundation for all of that.
Nearly 137 million cardholders. That's the base.
And the strategy that makes it all work is just ruthless limitation. Only about, 3,700 to 4,000 unique item SKUs in a warehouse.
Right. Compared to over 100,000 at a typical supercenter, they limit the selection and they limit their own profit margins on the floor.
Which is so counterintuitive.
It is. Until you realize the profit doesn't come from the stuff they sell. It comes from that fee they collect before you even touch a shopping cart.
Okay, let's jump right into that, the engine of it all, because this is the big aha moment for anyone looking at this company.
It really is. Most retailers live and die on their gross margins, right?
Yeah.
The markup on products.
For Costco, it's all about the membership fee.
The financial data is just crystal clear on this. Let's look at fiscal year 2024. The total fees they collected came in at $4.828 billion.
Okay. And the company's total net income?
$7.367 billion.
Wait, so the membership fees alone covered 2/3 of the entire company's annual profit?
66%. It's an almost unbelievable profit floor.
And it's consistent.
That's what investors love. The trend just continued right into the first quarter of fiscal 2026. Again, fees covered 66% of net income. It's this predictable high-margin cash flow that's the real secret sauce.
Right, because normal retail earnings are so vulnerable to, price wars, inflation, supply chain problems.
Exactly. But Costco's core profit is protected by a recurring subscription that, frankly, most members see as a way to save money, not spend it. It's a defensive purchase.
So if they're so protected, why bother with the razor-thin margins on the products? Why not make a little more money on, say, the Kirkland coffee?
Because the retail side is the moat. That's what protects the subscription.
Mm-hmm.
They treat the sale of goods as the cost of acquiring and keeping you as a member. If they started raising prices on the floor, they'd break that trust, they'd undercut the whole reason you pay the fee, and those incredible retention rates would just plummet.
Speaking of fees, they did just raise them in September 2024, first time in 7 years.
A very confident move, and a necessary one. The standard Gold Star and business memberships went up $5 to $65.
And the executive tier.
Up $10 to $130. And you have to remember, with a base of almost 137 million members, that extra income is basically pure profit. It's a huge tailwind for the next couple of years as everyone's membership renews.
And this is where the software comparison really clicks. The retention rates are just wild.
In the core U.S. and Canadian markets, you're looking at renewal rates of 92 to 93%.
That's insane.
It is. I mean, that's a retention rate that the best enterprise software companies would kill for. It's incredibly low churn. A competitor would need to spend billions just to try and replicate that loyalty.
And the executive members are the real power users.
Right. Oh, absolutely. They're about half the members, but they generate close to 3/4 of the sales. They have a massive share of wallet.
And Costco keeps them locked in with that 2% reward.
They do. And they just increased the reward cap from $1,000 to $1,250. That just further incentivizes the biggest spenders to consolidate even more of their household budget at Costco.
We did see a tiny dip in the global rate, though, just 10 basis points. Is that a crack in the armor?
Management says no. The sources are pretty clear on this. It's not because people in the U.S. are unhappy. It's because their strategy is working.
How so?
They're signing up more younger members, more international members, people who are more digital. And those groups, they tend to be a little more volatile at first. So it's a mix shift, not a sign of weakness in the core.
Okay, that makes sense. The structural integrity seems solid. Let's pivot now to how they can even afford to sell things so cheap. This is all about the operational moats.
This is where it becomes a game of math and culture. So we established that gross margin is held in this super tight band between 12.6% and 12.8%.
And just to remind everyone, how does that stack up against the competition?
It's not even close. Walmart's gross margin is around 24.4%. Target is even higher, maybe 27.5%.
So Costco is literally operating with half the gross margin.
Half. And that proves the price advantage isn't a gimmick. It's structural. Anytime they find a way to save $1 in the supply chain, they systematically give that dollar back to you, the customer. That discipline is the firewall.
And that firewall is built on the SKU paradox we mentioned. Only 4,000 items. Why is that so powerful?
It's all about buying leverage. You're funneling the entire purchasing power of 137 million people into a tiny, curated list of products.
So for any given product, they're the biggest buyer in the world.
By a mile. And that gives them power to demand discounts and terms that a competitor buying 100,000 different things just can't get.
Which leads us directly to Kirkland's signature. People think of it as a generic store brand, but it's not, is it?
Not even a little bit. Kirkland is a strategic monster. In fiscal 2024, Kirkland generated $86 billion in revenue.
86 billion.
Yeah. To put that in context, if Kirkland were its own company, it would be as big as or bigger than giants like Procter & Gamble.
That's unbelievable. So its job isn't just to be a cheap alternative.
Its job is to keep the national brands honest. The mandate is critical. The quality has to be as good or better than the name brand, but the price has to be at least 20% lower.
It's a threat.
It's leverage. If a big brand doesn't want to play ball on pricing, Costco can just expand the Kirkland version and squeeze them right off the pallet.
Beyond the products, they're also smart about real estate and labor, right?
Very. They prioritize owning their own land and buildings. This helps them avoid commercial rent inflation over the long term, which is a huge cost for other retailers.
And the famous high wages.
That's not charity, it's just smart business. Paying well leads to extremely low employee turnover, which saves a ton of money on hiring and training. The result is just stellar productivity. Costco generates over $850,000 in revenue per employee.
And the industry average is?
Around $348,000. It's not even close.
Okay, let's pause our deep dive for just a quick moment. If you like what you're hearing today, we invite you to subscribe, leave a like, and comment on what topics you'd like us to cover next.
And in the description of this deep dive, you'll find two important links. One to our sponsor, Broker360, and another to PayPal if you'd like to support this project.
Your contribution really helps us keep making content like this. We're only asking for the cost of a coffee. Thank you so much for your support. Okay, let's unpack the rest of this investment thesis.
Let's talk growth. Where does it come from?
Right, where does the future lie? The U.S. market has to be getting pretty saturated.
It is. Of their 914 warehouses globally, 781 are in North America. The U.S. is mature. So growth here is what they call infill, basically. Opening another warehouse in a big city that already has one.
Which is hard, expensive growth.
Very. So the real story, the secular growth, has to be international.
So Asia and Europe, where are the big bets?
Well, Europe is cautious. Only 5 stores in Spain, 2 in France. There are a lot of regulations, and it's just plain hard to find the huge plots of land they need. The real prize is China.
But they only have, what, 7 warehouses there?
Only 7. But those 7 represent the single most important growth opportunity they have. The brand just resonates so strongly with China's growing middle class. They value the authenticity and quality of imported goods, which is a core Costco strength.
And what about the other businesses, the things that aren't core retail, the gas stations, the food court?
Traffic magnets, they're designed to force you to visit regularly. Gasoline makes up about 12% of their total sales.
12%?
Yep. And it's a classic low-margin leader. They sell gas cheaper than anyone else, not to make money on the gas, but to get you to their parking lot. The thinking is, well, I'm already here.
Might as well go inside.
Exactly. It drives those impulse buys in the warehouse.
And then there's the ultimate symbol of their value proposition, the $1.50 hot dog combo.
The price has been fixed since 1985. It's more than a cheap lunch. It's a promise. It's a signal to the member that Costco will absorb inflation to protect your value. It builds that incredible trust.
Now, one area they've historically lagged is e-commerce. But the sources say That's changing fast.
Very fast. In the first quarter of fiscal 26, digital sales were up a massive 20.5%, and they're smart about it.
How so?
They're not trying to compete with Amazon on everything. They focus on big-ticket items. Furniture, appliances, things where the delivery economics make sense. And the key was their acquisition of Novel Solutions back in 2020.
Which is now Costco Logistics.
Right. It brought last-mile delivery for bulky items in-house. They turned a huge logistical headache into a real competitive advantage.
Okay, so let's bring it all home and tackle the elephant in the room, the investment dilemma. We've established it's an A-plus, bulletproof business, but that stock price.
It's aggressive. And this brings us right back to the valuation. Historically, Costco has always traded at a premium, maybe around 30 to 35 times its earnings, the PE multiple.
Right, and for context, a normal retailer might trade around 20 to 25 times earnings.
Exactly. But in 2024 and 2025, that multiple just exploded. It pushed up into the 45x to 55x range.
The market is pricing it like a tech stock.
Because of that recurring revenue.
Yeah.
So let's hit the bear case. What's the single biggest risk when a stock is priced for perfection like this?
Multiple compression.
That's it. It's the biggest risk by far. If growth slows down even a little bit, or if market sentiment just changes, that PE could shrink from 50x back to its historical average of 35x.
And even if the business is still doing great, the stock could see a 20 or 30% correction.
Easily. The other big risks are the ones we touched on. Saturation in the U.S., which makes growth harder and more expensive.
And succession risk.
Yes. The culture at Costco is everything. And when you have major leadership changes, like the recent CFO transition after Richard Galante's long tenure, there's always a risk, a degree of uncertainty.
Okay, so that's the risk. What's the bull case? What could push the stock even higher from here?
Well, beyond the steady profits from the fee increase, the really exciting catalyst is the rise of their retail media network.
Meaning advertising.
Exactly. Costco has this unbelievably rich data on what 137 million loyal, high-income customers are buying. They can sell targeted ads to their suppliers.
Like Amazon and Walmart are already doing.
And it's an incredibly high-margin revenue stream that doesn't mess with their core promise of low prices. It's found money.
And you can't forget the special dividends.
Never. That's a huge support for the stock price. They have a history of building up cash and then returning it in these massive one-off dividends, like the $15 per share they paid out in January 2024. The market knows more are probably coming, and that creates a floor under the stock.
So, final verdict. A-plus business, but it's priced for perfection. For someone looking to invest new capital today, what's the play?
I think prudence is the word. The risk-reward at these levels is tight. For me, the best strategy would be gradual accumulation.
Yeah.
Dollar cost averaging. You don't want to bet the farm at what might be the peak.
But here's the dilemma, right? If the market is now permanently treating Costco like a premium subscription business, maybe that old 35x multiple is gone forever. Maybe waiting just means missing out.
And that is the multi-billion-dollar question. If you truly believe the size analogy holds up, then yes, the premium is justified. But as an investor, you have to stay disciplined. I'd still say wait for a market correction, some volatility that brings that multiple back into the high 30s or low 40s.
Yeah.
The business isn't going anywhere.
So what's the final provocative thought you want to leave the listener with? The one thing to mull over.
It's the sheer financial resilience of the model. That's what it all comes down to. The predictability of a 90+% renewal rate gives Costco a profit floor that no other retailer has. That floor is what insulates it from all the chaos and volatility of the market. That's the difference. That's the moat.
And with this, we reach the end of today's deep dive. We hope you enjoyed it, learned something new, and will join us for the next one.
Thank you very much, and we'll meet again very soon.
Remember that in the description of this deep dive, you will find PayPal if you want to help us out. We really appreciate it. Thank you once more. Bye for now.